Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Connon, along with Spencer Israel and Brianna Valesky, and we have Jill Malandrino on the line from TheStreet.com. Jill, how you doing on this Tuesday morning?
Doing very well. Thanks for having me back.
All right, so we had the flash crash, we had the market hanging out, and boom, we're back over 2,000 in the S&Ps coming in earnings season. Give us your take on the market.
Well, it certainly has traders and investors scratching their heads because fundamentally, whether you agree with what's happening with global macroeconomic data, earnings have really not been that spectacular. In fact, the beat rate's only at 63%, which is below the historic average of 66%. It's pretty frustrating to see the market just essentially skyrocket to new highs, but I think there's other factors at work here. There is a tremendous amount of short interest out there, and I think that's one of the things that we're seeing with this rally. In fact, JP Morgan put out a note this morning saying that they see another $90 billion of short covering to go. So in addition to people almost panic buying on the sidelines, and you have all the short covering occurring as well. I think there certainly is more room to go here. I wouldn't be surprised to see us get up to 2040. And, like we were saying in the beginning of the year, anywhere from 1920, 1940 to 2040 really could be the range that we'll be in. I think once we've hit those highs, we will remain range bound. But I do think there is some more room here. We'll see what happens as earnings play out. In fact, we're only in the first innings of it with just about the big banks and the industrial conglomerates reporting. But next week when we start to get into consumer discretionary earnings, that's something that I really want to focus on because that will really be a gauge of consumer strength, and we'll also get some more data points and guidance going into holiday 2015, and I think it'll be interesting because I think it's going to be a tale of the have and have-nots, as it always is in retail. And I think your strong retailers are going to be your discounters and your athleisure brands like your Under Armour's, Nike, VFC is one of my favorites. I think that's really where the trend is going to be, in addition to consumer electronics. And if you're not in those categories, going to be a struggle this holiday.
Yeah, you made a great point there. We had that long consolidation in the market through the summer months. We held that 2030, 2040 support level, made a couple, charges above 2100, but finally in August when we broke down through that level, you had some other factors, but the flash crash included, and now we're coming back up to that former support level. A lot of people are glad to see the market up there, I'm sure. So you started to break down the retail earnings here, and I guess, I don't know what, you can call it tech, you can call it retail, but boy, the market's been moving up. Apple had its big move off the lows here, but it's kind of a, forgotten stock over the last couple weeks here. What's your take on Apple?
Mm-hmm. I think Apple's going to continue to perform, and it's a name that I would certainly have in a portfolio. Almost can't not own it. There was some positive news out of the tech conference that was held last night, the Wall Street Journal tech conference, and Cook had revealed that the fairly new Apple Music had 6.5 million paying customers. That means these customers are paying $10 a month. That equates to annual revenue of over $780 million. Not huge for Apple, but it still is a pretty dynamic revenue stream. And even as big as a company as Apple is, that's still a fair amount of revenue just out of the gate. And Cook also mentioned that they have another 8.5 million subscribers on free trial at that moment. So they still have that vertical where they're looking for a tremendous amount of conversion there. And I think it's going to continue to perform well into the holiday season. Consumer electronics is really where the trend is right now. And back to what I was saying before, with consumer discretionary, that's going to be a vertical where you're going to see customers putting their money to work. And there's also on the hardline retail side, in terms of clothing trends, where you're going to see, like I said, your discounters and your athleisure trends as well.
Okay, let's talk consumer discretionary here.
Mm-hmm.
Some of those stocks have some nice dividends, been beat up. Everyone worried about interest rates, going higher. So, hey, these stocks were kind of left out. Why don't you give us your three favorite consumer discretionary
Oh, sure, yeah.
stocks,
Well,
and maybe three that have already had a nice run, and maybe expectations are a bit too high.
sure. Well, my favorite one is TJX right now. I also like Ross Stores, but I think of the two, TJ I really like a lot. It's consistently stealing market share from single brand retailers and department stores. The CEO plan, they just announced a successor, Ernie Herman, last week. This was a plan that's been in place since 2011. He was named president at that time, so this is not a surprise to the marketplace. So he was the leading candidate going into the announcement. In today's environment, customers expect a deal, and they're looking for steep discounts on designer labels, and vendors saw this trend and how effective TJ has been at selling their products at a growing and a growing percent of products are being made exclusively for TJ because they have the ability to push products off the shelves. In fact, revenues didn't fall for TJ during the 2008-2009 recession, and last year it even outpaced Macy's, and that streak continues. Even with Nordstrom, Saks, Neiman, Macy's expanding all of their off-price stores and offerings, TJ just continues to take market share. The key here is the pace of their inventory turnover, and that's what keeps merchandise fresh. You would think if you go to a TJ that they're getting old product from department stores or from single brand retailers, and that's simply not the case. Their inventory turnover is quite impressive. Therefore, there's constantly fresh merchandise. Continuing to expand internationally, they relaunched their internet effort, and I think this is a name that's going to continue growing, and it's a great holding to have in your portfolio. I think we saw a little bit of volatility in the market, not this week or the week before, but in the beginning of October, where there was some great premium opportunities to get some premium sales in there as fall was a bit elevated, and that's worked out well. And I think even here it's just an attractive area to buy the stock itself. Again, like I said, Ross Stores, ROST is another one that I'd be looking at as well, and that's been quietly performing. Other names I love are the athleisure trends, and we've been talking about this all year. Under Armour, Nike. Under Armour reports October 22nd. I'm curious to see what their numbers look like, especially out of that strong analyst day that they had in September that just set the stock off on quite a trajectory. Nike, another one. VFC is another one that I absolutely love. They report on October 23rd in the morning, and they've been growing pretty good as well. They grew revenues 4.7% last quarter over second quarter of 2014. Solid brand portfolio, again in that trendy area with Timberland, North Face, and Vans, which is huge right now, Nautica, JanSport, and what they're doing is they're focusing on strategic acquisitions and expanding their global operations. In fact, the company has said that they want to focus more on outdoor and action sports brands. Those are the most attractive for names that they may look to acquire. So think of your Columbia Sportswear, your Performance Sports Groups, your Quicksilvers that have been underperforming but are in verticals that a VFC may be interested in taking a look at. So I would say VFC and TJX are my two favorite right now. I was an Urban fan. I thought that the operational change that they've been making over the past 18 months was playing out well. But and a few analysts out there happen to agree that the product mix isn't quite moving as well as I had expected. So that one, as bullish as I was on it, I don't think they're going to perform as well for holiday 2014, and Gap continues to struggle with the exception of Old Navy. But I think right now consumers in the economy that we are in right now expect an immediate deal. Again, we're in an on-demand economy right now, and I think this is why you're going to see your TJs, your Ross Stores perform well, and the athleisure groups.
And we had the big executive change. You're going to have to refresh my memory here, but God, for a week you had someone leave Gap, right? A high ranking,
right?
And just refresh my memory on where they went.
It was Old Navy, and they went over to. I'm drawing a blank right now. It's on the tip of my tongue, and I'm drawing a blank, and I can't remember. But
and they got a huge lift off it too. I was just trying to think to see.
I know. I don't know. I can look it up right now. I'm drawing a blank, but
yeah. Let me get it here. Let me go to my trusty Benzinga Pro here. But anyways, while we're doing that,
Oh, Ralph Lauren. That's it.
Okay.
I knew it was one of the upper echelon brands, which was interesting because you would think the guy who's running Old Navy goes over to Ralph Lauren, which is known as more of a high end kind of brand. So you will continue to see that will be an interesting story to watch play out, because Warren's still going to be on to serve as chairman, and he's going to be head of its design team, so you're not going to see major tweaks there. But it'll be interesting to see how his replacement, Larson, his last name is Larson, uses his operational expertise to right-size Ralph Lauren. And Old Navy has been the best performing division at Gap, so it'll be interesting to watch on both ends.
Yeah, and this is maybe a little bit out of your wheelhouse, but I consider Yum a retail stock, right? I mean, they sell to consumers here.
Right.
Gets beat up just after earnings, very disappointed here. And, they come out with a little bit of this, financial engineering here, and they're getting a nice pop. Now, since we started the show, they've given back a lot of those gains. I mean, what do you think of these kind of moves? I mean, they're not really reflective of earnings. They're kind of saying, okay, well, China's not doing too good right now,
Right.
so let's separate our company from China. Not a big fast food eater myself, nor less, Taco Bell or KFC, but what do you take? What's your take on these financial engineering moves?
Right. Same thing too. I mean, I agree with the move. I mean, you do have to separate the two, because clearly China has been an underperformer for the company, and that's been the case for quite some time. In terms of quality of the food, I'm not a fast food eater myself, so I can't really comment on that. But that's really the trend, and you're starting to hear more about this, whether it's on network or on analyst notes and so forth, where you're getting the sense of frustration in the marketplace that engineering to make earnings is, stocks aren't getting rewarded for that as much as they are right now. Buybacks, you're not seeing that pop in the stock like you would have in the past. If you're not growing revenue and the only way you're making your earnings is via cost cuts or through financial engineering, that's not a positive thing for any stock. And I think that's the trend that we're seeing, with the exception of very few companies. There's not much that I've seen out there. And we've even seen it with the banks. I didn't think the banks were that impressive at all. The Bank of America, which was decent, but look at Morgan Stanley. It was an abysmal quarter. There's not much out there, regardless of what sector, that's impressively growing earnings. Now, again, once we get into the retailers next week, I'll be curious to say, I think that's going to be one of your bright spots in the market. Again, depending on what subsector of retail you're in. But financial engineering, you can't expect to have your stock rewarded when you're not growing anything. Even in consumer staples, a big trend right there, and there's pockets of that I like as well, where they're growing via acquisition. You're not seeing organic growth anywhere, and it's really hard for the marketplace to reward a stock, and it's incredibly frustrating watching the S&P skyrocket every day, and the excuse that there's money on the sidelines, or the S&P, the SPY short interest is the highest it's been. In fact, it's the highest of all stocks and ETFs out there. It's frustrating to see that as the main metric for the market to continue to move higher, when individually there's nothing that's that slam dunk impressive.
Let's move on to some of the consumer staples that you mentioned there that are you're trying their own hand at financial engineering here. Do you have any of those, maybe with a nice dividend or something? You get a little bit of dividend protection.
Yeah, I think Kraft Heinz is not the sexiest story out there, but I think that's going to be pretty interesting to watch. Obviously, private equity is involved in there, and they've done a pretty good job at turning around Heinz, and I think they're really going to focus on right-sizing Kraft as well. So that's something that I would like to see play out. Mondelez is another one. My favorite within the sector is J.M. Smucker, SJM, and again, that's another company where they are right-sizing. They're investing in growthier verticals and consumer staples. Pet, for example, the pet trend is tremendous right now. They just did that big acquisition in February, and we'll start to see how that's accretive to the balance sheet as it's anniversarying on that. And SJM is definitely one that I think is a quiet one, but a good one to watch. I think they're growing in the right verticals, and that's what we're looking for right now, is to see what's spinning off, what assets are underperforming that companies are starting to shed, and where they're investing in more growth areas. Like organic, for example, is a huge trend. Pet is a tremendous trend. So those are things I'm looking for in consumer staples.
Yeah, boy, this is bounced back. I remember, I think before I took a small break, I saw this thing tank down under 107. We're right back up at 120 here. I'm not sure if we're knocking on the door of all-time highs here or not,
right.
But what a tremendous rebound. How all right. So we were talking about the TJXs and the smaller, lower price retailers. Everyone likes the deal. But what about some of these big stores? How about your Kohl's, your Macy's, your Targets, those
Yeah.
companies? Give us your take on those, Jill.
Well, clearly people are going to be skittish because of Walmart, right? I think department stores are going to continue to struggle relative to the TJs or the Ross stores or the brands, the single brand retailers that are on trend. I think one of the biggest problems that these major department stores have to contend with is they might have invested in their technology a little bit late, whether it's online or competing within Amazon. And just take a look at in Amazon versus a Walmart, and I think that's really where they're losing a lot of market share and will continue to do so. They were sort of late to investing in technology, and they will continue to struggle. I think right now the consumer is very focused on getting a deal. It's the on-demand environment where we want everything same day or yesterday, hence in Amazon. And then you also have this athleisure trend. I just don't think that the big department stores can necessarily compete with. That said, you do have one of the names I had mentioned, VFC Corp, ticker VFC. They distribute to major department stores, so certain verticals there will do well. Your North Faces, your Timberlands, your Vans, and so forth. But again, I think these single brand athleisure retailers and the discounters are going to outperform, and department stores are going to continue to struggle. Again, foot traffic is down. It's a declining trend. That's not a surprise, and I just think they're a little bit late to the game with their online offerings.
Yeah, I'm looking at this JW Nordstrom. That thing's been weak here. I'm guessing if you're trying to pick a bottom here, you did make that low at 66 a few weeks ago. But yeah, it seems a lot of challenges. Well, Jill, I
Right.
think you just covered about 42 stocks there in that segment. We really appreciate you.
Of course, anytime.
You're a special guest on our show covering the retail sector. Jill Malandrino of TheStreet.com joining us here on Benzinga's Pre-Market Prep. Thanks again, Jill. We'll be talking to you again soon.
Okay, great. Thanks so much.